Here's the video lecture for Chapter 8, which has 3 parts. The first part deals with rental property, where we strictly just rent out and there's no personal use by the landlord. In Part 2, we have a mix of personal use of the landlord and also renting out, called vacation home. And then the last part, Part 3 of this Chapter 8 video lecture, deals with the other topics, royalties, and income from flow-through entities. Flow-through entities are things like partnerships and a type of corporation called S corporation, both of which we'll cover in the last chapters of the semester. So rental property is considered to be income, the rent income, and we minus out related expenses. This is not the same thing as a trade or business that we had learned about back in Chapter 6. In a trade or business, the taxpayer is working, and not only do they pay income taxes on their business profits, but they also pay self-employment tax or Social Security taxes on that profit. Whereas the income or net income of a rental property is sometimes called a production of income situation and not a trade or business, which could be good because the profit of a rental property is not subject to that self-employment tax. Even though the landlord could be a very hard-working person, making sure that the operations and the maintenance of the rental property is running okay and spending a lot of time doing that, generally, that landlord is not considered to have a trade or business, but a situation called production of income. And that landlord can deduct all the ordinary and necessary expenses for that rental property, which we'll see when we take a look at a Schedule E. And of course, that's where we report the rental operations. Versus a trade or business we saw back in Chapter 6 was reported on a Schedule C. Ordinary expenses basically is the same type of rule we saw back and in Chapter 6, what is customary and usual for that typical activity, in this case a rental property and not a trade or business. So again, we'll see some of these examples when we take a look at a Schedule E. Rental properties expenses also includes depreciation, again a topic back in Chapter 6. But here, the main thing we're depreciating is the improvements on the property, the structure. So if the depreciable structure is a residential property where people live, like an apartment or a home, then the cost allocated to the structure can be depreciated over a 27.5-year life. Remember, we use the straight line method when depreciating real estate. And if the structure is non-residential, like a office building or a farm, then we have to use a 39-year life. Again, we use the straight line method, and in the back of our Chapter 6, there's depreciation tables we use for personal and real estate. In the case of real estate, we're using a method called the mid-month method, where you assume that you bought the real estate in the middle of a specific month that you had purchased that real estate. And from then on, you would use that same column in the depreciation table to determine the annual depreciation for each year you own the property. Here it says if a taxpayer's rental property is considered a trade or business, then you can combine that with the other trade or business income and expenses and report it on a Schedule C. The common situation where this applies is if the taxpayer were a real estate professional, like a real estate broker or real estate salesperson, and if that's their main job and it's incidental that they own real property that they rent out and they manage that property, they can combine the rental operations with their regular real estate business operations. If you remember a couple of slides ago, I mentioned the rental was reported on Schedule E, and the profits there are only subject to the income tax and not the self-employment tax, whereas the Schedule C business, trade or business income is subject to both income taxes and self-employment tax. So if you combine the income here on a Schedule E for real estate professionals, you're going to be probably paying more taxes. But especially like a place in Hawaii, most rental operations, most landlords or small landlords that have own few properties, they probably run an operating loss. In other words, more expenses than deductions. Typically, if you buy a property and you pay a mortgage, the rent you collect will not even cover the mortgage, and you have lots of other expenses in addition to the mortgage. So in the case of losses, the losses for their rental property can be offsetting the profits from their business, reducing the income taxes and the self-employment taxes. We'll talk about a limitation called passive losses a little bit in this chapter 7, but more so, I believe, in the next chapter 13. We're going to focus on a, a limitation to the amount you can deduct for rental losses, more specifically, something called passive losses. Expenses paid by the tenant or services provided in lieu of rental payments are considered to be rental income to that landlord. In other words, here is the tenant and here is the landlord. And typically every month the tenant would pay some type of rent, or let's say cash, and that cash would be income to the landlord. But if the tenant pays an expense to some third party or works on the property to fix it up, that's really to the benefit of the landlord. It's almost like the tenant paying cash to the landlord and the landlord would pay that expense. But here the expense is paid directly by the tenant. This amount paid by the tenant for the property, for the landlord, is considered to be income to the landlord. And in turn, the landlord will report that income. But also the landlord would get to deduct that same amount as an expense. So here's the revenue and here's the deduction or expenses. And included in both, offsetting each other, would be that expenses being paid by the tenant. So the ultimate is that it's not reflected in the rental profit or net income. Example, Brady has a rental property that he rents to his friend, and it really doesn't matter if it's a friend or not. Jack pays $800 per month. In November, though, Jack repairs a leaky roof of the rental, and he pays $450 for that. And then he pays Brady the balance of the rent of $350. Because this expense is really an expense of the landlord, it's really like this total amount of 800 is rent being paid to Brady, and then Brady pays that $400 of repair expense. So for the month of November, if you were to report the revenue, that would be 800, and minusing out the expenses, including the repair of 450, would give you a net rental income of 350. But you gotta report all of that rent, and now you can take a deduction to get this net figure and not just report 350 as the rental income for November. Question 1. Rental income is generally reported on Schedule E. That's true. We know business income is reported on Schedule C. Number 2. All expenses related to rental property are deductible in the current year, including capital improvements. Capital improvements means assets. And we know from chapter 6, an asset that lasts a relatively long time, like years, is not deducted at the time you buy the asset, but depreciated over its assigned life. So here, number 2 is false. In number 3, rental property structures must be depreciated using the straight line method, like we had learned back in chapter 6. That's a true statement. Number 4, if a taxpayer's rental property is considered a trade or business, that's for real estate professionals, she or he would report the income on Schedule E. No, we said that would be combined on the business Schedule C. And number 5, if a tenant provides a service in lieu of rent, the taxpayer, our landlord, is not required to report the value of that amount as rental income. That's false. He has to report that as income, but also that landlord, the taxpayer, can deduct that amount as a rental expense. Here's an example of a Schedule E that would eventually be attached to our taxpayer's 1040 form. And on this front page of the Schedule E, you would report rental, real estate, and royalties. Here in line 1, you have space for 3 different properties. So if you own more than 3 properties, you would have attached additional Schedule E's where you would write in the type of property, let's say apartment, and the location, address, or city, the next type of rental real estate and location, and so forth. Now, in question 2, you have to answer this question here, and we'll see this applied in the next slideshow, part 2. Here's the question. For each rental real estate, that's A, B, and C, did you or your family use it during the tax year for personal purpose, personal use, and not renting it out for the greater of either 14 days for the year or 10% times the days you had rented the property? So if you had rented the property for 150 days, then the question would be, did you use it for more than 15 days? 10% of 150. And checking yes probably means there may be limitations to any rental losses. You cannot deduct the loss, or maybe it's partially deductible. If you check no, then the loss may be fully deductible, although still subject to some other limitations, which we'll learn in chapter 13. Okay, in line 3, you would write down the amount of the rental income received for the year for each of your properties, and then the total of all the properties here in the last column. Royalty income we'll talk about in our part 3 slideshow. And then the related expenses for your rental property here, pretty much listed in alphabetical order, would first be advertising, and you would have to maybe pay for a classified ad to show that you have a vacancy, although now more and more people are not putting ads in the classified sections of newspapers but are using online services like Craigslist, which is free. But advertising was a typical expense landlords would incur when they had a vacancy that they're trying to fill. And if the landlord has to travel either to a far location or to drive to their rental property to manage and operate it, they get to deduct that traveling costs. I know a taxpayer here in Hawaii that traveled every year to Las Vegas because he had some rental property there. So he flew up there and he looked at the property. He talked to the property manager up there. Of course, it was just incidental that he went to the casino a few times during that trip. Yeah, but the main purpose was for that rental operation, so he got to deduct his travel. The landlord may incur some type of cleaning costs to get the property ready for use, or ongoing maintenance like yard work. And again, if the tenant does the yard work in lieu of rent, that rent has to be, or that value has to be included in here, but also the landlord gets to deduct it over here. Commissions may be paid to some type of real estate professional that finds a tenant for the landlord. Insurance on the real property, possibly liability insurance also. Maybe you're paying an accountant to handle your bookkeeping for your rental properties, or some legal work in trying to collect rent using a lawyer. Management fees, if the property is professionally managed, like you hire someone to help get a tenant, to collect the rent, to take care of repairs. Uh, they probably do this for a fee, something like maybe 10 or 15% of the rent collected. Well, you have to report all of the rent here, but you get to deduct the amount kept by that property manager. A mortgage is a loan secured by the property. So in case you default, the bank will repossess the property. And here, any interest paid on that loan gets to be deducted here. And this is probably one of the biggest costs for property owners. Most people can't afford to pay cash for a property, so they would borrow the money and pay interest. And again, I mentioned for lots of properties, this mortgage interest is probably bigger than the rent they collect. So you probably end up with some type of loss at the bottom of this schedule. Repairs is sometimes a controversial item. Repairs is just for maintaining the property for regular operations. Now, if you have a big improvement to the property, that's really an asset, like an addition to the property, increasing the value of the property substantially. What can be tricky is even some repairs can be very expensive, like painting a building could be tens of thousands of dollars, but because that's something usual and reoccurring, we can probably deduct that as a repair. Something a little bit more gray would be, let's say, replacing the roof of a building. Roofs most times do not last for the life of the building, so maybe we would have to depreciate or deduct the cost of the roof that was abandoned or destroyed and replace and add on a new asset to depreciate if you do something like a major re-roofing. Supplies could be just for maintenance or for office items that you use to keep track of your rental operations. Taxes is probably maybe real estate taxes you pay on each of your properties. And here in Hawaii, you also would pay general excise tax on the rent income, that 4 or 4.5% that you possibly could pass on to your tenant, which you would tack on to the rental income. But when you pay it to the state government, you get to deduct it over here. You may have a separate meter or separate charges like phone for your tenants, but if you have water going through just one meter, electricity going through one meter, then you possibly can deduct the cost of that utilities here. And then if there's other items not itemized up here, you can write it here in this other section. Here's a subtotal of the expenses, and then a major expense that it's not cash based, but here depreciation that again we learned back in chapter 6 would be first calculated or reported on form 4562 and then reported here for each property. You get a total of all the expenses and you subtract it from the rent income in line 3 to get either a net income for the property or a net loss. There are limitations to this amount of loss being deductible, and we'll see one limitation is called at-risk rules reported on this form, and we'll see more of that in chapter 13. A more common limitation to losses is called passive loss limitations, and again we'll see this form being utilized. And I have one posted in chapter 6, but more so we'll take a look at it in chapter 13 that may limit losses. In fact, here you can see already the brackets to report the loss. So basically income is reported here for each property and loss is reported here. The total of the income and the total of losses then can be combined together here, and this total net income or net loss is now reported on your Form 1040, line 17. Okay, so this again is a Schedule E where we report real estate rentals.